Today I'm talking about Ondas, ticker ONDS, and this is a stock that, in my view, is much more complicated than it might look at first glance. A lot of people may still think about Ondas as some kind of small legacy wireless or rail communications company, but based on the business as it stands today, that is really not the main story anymore. Ondas has essentially become a high-risk defense and autonomy platform builder. The core of the company now is Ondas Autonomous Systems, and that business includes autonomous drones, counter-drone systems, ground robotics, sensors, intelligence platforms, and now even stratospheric ISR through Worldview. So if I had to summarize the company in one sentence, I'd say this. Ondas is no longer really a legacy networking story. It is now a speculative defense tech and autonomy platform story. And that shift matters a lot because it changes how I think about the business, how I think about the financials, and how I think about the stock. The reason ONDS has become interesting is pretty straightforward. On one hand, the company showed very strong revenue acceleration in 2025. On the other hand, it also raised a huge amount of capital and is moving very aggressively through acquisitions. So this is not just a story about a company growing, it is also a story about execution risk, integration risk, dilution, and whether management can actually turn a growing list of acquired assets into a coherent platform. For me, that is really the heart of the ONDS debate. At a high level, the bull case is easy to understand. Defense spending is rising, counter-drone demand is rising, autonomous systems are becoming more important, and Ondas is trying to build a broader integrated offering rather than just selling one isolated product. If that works, the company could become much more valuable over time. The bear case is also easy to understand. The company has moved extremely fast, dilution has been massive, acquisitions are piling up, and the valuation already assumes a lot of success. So even if the business keeps growing, the stock may still disappoint if the growth is not high quality or if per-share value creation does not follow. My overall starting point is this. I think ONDS is intriguing but still highly speculative. At today's price, I would not call it a high-conviction long-term investment. I would describe it more as speculative or watchlist territory, and only really suitable for investors who are comfortable with aggressive acquisition-led growth, integration risk, and future dilution. Let's start with the business itself. Ondas operates through two reportable segments: Ondas Autonomous Systems, which is the part that matters today, and Ondas Networks, which is the older mission-critical wireless business built around the FullMAX software-defined radio platform for industrial and rail applications. Economically, this is now almost entirely an Ondas Autonomous Systems story. In 2025, OAS generated $49.8 million of the company's $50.7 million in total revenue. Ondas Networks generated only about $1 million. So when we talk about ONDS now, we are basically talking about the autonomy and defense business. In terms of how the company makes money, OAS generates revenue from a mix of product sales, service revenue, and development revenue. For full year 2025, the company reported $50.7 million in total revenue, including $34.6 million in product revenue, $10.2 million in service revenue, and $5.9 million in development revenue. In practical terms, that means Ondas is monetizing drone and counter-UAS system sales, software and support tied to deployed systems, defense and public safety programs, acquired robotics and sensor businesses, and then to a much smaller extent, its rail and industrial wireless communications business. Its customer base is mainly defense, homeland security, public safety, airports, critical infrastructure, and government agencies. The recent examples mentioned include military customers, a major European security agency, Middle East customers, FIFA World Cup security deployment, and border and demining engineering programs. Now, when I look at the company's positioning, the strongest positive is probably breadth. Ondas is clearly trying to build a multi-domain autonomy stack instead of relying on a single product line. Management's argument is that the company now has capabilities across aerial ISR, effectors, counter-UAS, ground robotics, sensors, and AI-enabled command and control. If customers increasingly want integrated solutions instead of standalone hardware, that could be valuable. But I think it is important to be careful here. Breadth is not the same thing as moat. Right now, Ondas looks more like a rapidly financed roll-up than a clearly proven integrated platform. The moat question has not really been answered yet. The investment thesis depends on whether these assets become more valuable together than they would be separately. That is still an open question. The big industry growth drivers are pretty clear. Rising defense spending, rising counter-drone demand, greater use of autonomous and robotic systems in military and security settings, larger integrated programs, and Ondas's ability to use its balance sheet to acquire more capabilities. Those are all real tailwinds. The caveat is that the company is still proving whether that demand can turn into durable, scalable, profitable revenue, rather than just a lot of headlines and momentum. Now, let's move into the recent financial progression, because this is where the story starts to get more interesting. The last 4 quarters showed a real revenue ramp. In Q1 2025, revenue was $4.2 million. In Q2, it was $6.3 million. In Q3, it rose to $10.1 million, and then in Q4, it jumped all the way to $30.1 million. That progression matters a lot. It suggests the company moved from smaller early shipments to larger scale deliveries, and then into a much bigger Q4 step-up, helped by both core platform demand and acquired businesses. So this is not just a pure concept stock anymore. There was real top-line acceleration in 2025. For the full year, total revenue reached $50.7 million, up from $7.2 million in 2024. OAS alone generated $49.8 million, up from $5.3 million in 2024. Meanwhile, Ondas Networks declined to $1 million from $1.9 million. Again, that reinforces the point that the identity of the business has changed. This is basically an OAS company now. Margins improved, but they were still volatile. Gross margin was 35% in Q1, 53% in Q2, and 26% in Q3. For the full year 2025, gross margin was 40%. That kind of volatility is pretty normal for a small, fast-scaling hardware and systems company, because product mix can make a huge difference quarter to quarter. Q2 benefited from a favorable product mix, especially Iron Drone. Then Q3 stepped down again, which is a reminder that these are not stable software-like margins. Still, on a broader basis, margins were better than in 2024, and that does suggest some improvement as volume scales. The bigger issue is that even with strong revenue growth, the company is still deeply unprofitable. Operating loss was $10.3 million in Q1, $9.2 million in Q2, $15.5 million in Q3, and $23.3 million in Q4. For the full year 2025, operating loss was $58.4 million. So yes, revenue exploded higher, but costs also exploded higher. The company has been scaling headcount, acquisitions, leadership, integration work, and public company overhead very aggressively. This is very clearly a growth-first, earnings-later setup. And this is an important distinction for investors. The revenue trajectory looks strong. The profitability trajectory is still very uncertain. There is also a wrinkle in the net loss numbers that matters. Q4 net loss was $101 million, and full-year net loss was $133.4 million. But those numbers included an $82.2 million non-cash warrant liability charge tied to the October 2025 raise. That matters because the accounting loss looked much worse than the underlying operating trend. It does not mean investors should ignore dilution or the financing structure. Those issues are still very important.
But that particular Q4 hit was not an operating collapse. When it comes to cash flow and the balance sheet, this is where the story becomes almost unusual for a company of this size.
Ondas used $38.7 million in operating cash in 2025, compared with $33.5 million in 2024. At the same time, it raised $862.7 million during 2025, ended the year with $594.4 million of cash, cash equivalents, and restricted cash, and then raised another roughly $960 million net in January 2026. According to the April 2026 proxy, cash and cash equivalents were in excess of $1.4 billion as of March 31st, 2026. That is both a major strength and a major warning sign. It is a strength because the company is not liquidity constrained right now. It has real firepower. It can fund working capital, absorb losses, pursue acquisitions, and keep building.
But it is also a warning sign because the company is very clearly using capital markets as a growth engine. This is not just a company raising a little bit of cash to get through a rough patch. This is a company using equity and finance to drive expansion. And that leads directly into the dilution issue, which I think is one of the most important parts of the ONDS story. As of March 25, 2026, the 10K showed 467.1 million shares outstanding. By the April 9, 2026 record date, the proxy showed 481.9 million shares outstanding. On top of that, there were another 196.3 million shares reserved for outstanding warrants and 56.1 million for options, RSUs, and awards.
That is a huge share count and a huge overhang. Some of those warrants are out of the money at current prices, but the broader point is clear. Share dilution risk is not some minor detail here. It is central to the thesis. If you own ONDS, you're not just betting on revenue growth. You're betting that management can create enough per-share value to overcome heavy dilution. And I think that is the right lens for the stock. Now, let's talk about the acquisitions and strategic expansion, because this is really what management has been doing through 2025 and early 2026.
The period was dominated by acquisitions and platform expansion. Management highlighted deals including 4M Defense, Centrix, Roboteam, Rotron Aerospace, Bird Aerospace, IND Earth, the announced Mistral deal, and then the completed Worldview acquisition on April 1st, 2026. This is why I think investors need to be careful when looking at the growth story. The growth is real, but it is not purely organic. Part of the acceleration is tied to acquired businesses and a much broader scope. Management itself said that 2025 revenue was helped by acquired businesses, and that 2026 growth includes significant contributions from recently acquired businesses.
So, the cleanest way to frame it is this. Ondas has real demand, but it is also growing aggressively through external expansion. That does not make the story bad. It just means the growth is not as simple as saying this one original product got traction and now the company is scaling naturally. The story is more complex than that. On margins, the company says it is targeting product-level profitability by Q3 2026, OAS-level profitability by Q3 2027, and company-wide profitability by Q1 2028. That is management commentary, not reported fact, and I think that distinction matters.
There is margin potential here, absolutely. A scaled defense systems integrator can generate healthy margins, but a group of acquired, hardware-heavy businesses with ongoing integration costs may not. So for me, the path to better margins exists, but it is much less certain than the path to higher revenue. Free cash flow is another area where the company is clearly not there yet. Ondas burned nearly $39 million in operating cash in 2025 and used $260.1 million on acquisitions and strategic investments during the year. So this is not a self-funded business, not even close, at least right now.
The more important question is whether the current cash pile can eventually be turned into durable earnings power without damaging per-share economics along the way, and that is still unproven. In terms of management and capital allocation, I think the fairest view is mixed. Management deserves credit for changing the shape of the business quickly. Revenue inflected, backlog rose, capital was raised, and a large number of deals were executed. This is not a passive management team. But the harder question is whether this has been good capital allocation. The company explicitly describes what it is doing as a core plus strategic growth program, and it's even seeking to increase authorized common shares from 800 million to 1.2 billion. That tells me management is behaving more like a capital allocator and platform consolidator than a typical single-product operating company. That can create a lot of value if the acquired assets are strategically coherent and synergies are real, but it can also destroy value if integration is weak and equity is treated as endlessly cheap. So my assessment here is that execution energy is high, but capital discipline is still unproven. I would want to see evidence that these acquisitions actually lead to better margins, stronger cash conversion, and better per-share economics before giving management too much credit on long-term capital allocation.
If I had to lay out the SWOT analysis in simple terms, the strengths are pretty clear. The balance sheet is extremely strong relative to the current revenue base. The company did show real revenue acceleration in 2025. Backlog expanded. The product footprint is broader now across drones, counter-UAS, ground robotics, and ISR. And there does seem to be genuine demand from defense and security customers. The weaknesses are also clear. The business is still unprofitable, still burning cash, still very acquisition-heavy, and still highly dilutive. The old Ondas networks business is small and not very important to the story. And the investment case depends heavily on management integrating a lot of assets quickly.
The opportunities are obvious too. If Ondas really does assemble an integrated autonomy stack, it could move into larger, multi-domain programs, win more recurring support and service revenue, and benefit from rising demand for counter-drone systems, ISR, robotics, and military engineering solutions. The threats are probably where investors need to spend most of their time. Integration failure, overpaying for acquisitions, dilution, press release momentum outrunning actual deliveries, slower than expected conversion of backlog into revenue, and valuation compression if revenue scales but margins stay weak. That last point is especially important because ONDS looks like one of those stocks where the business can grow a lot, but the stock can still disappoint if the quality of that growth is not good enough. I also think there is an interesting market perception issue here. Ondas is not really just a tiny speculative drone stock anymore, but I also don't think it should be treated as a proven scaled defense prime. It is somewhere in between. It is a capitalized defense tech platform builder that is still in the middle of proving itself. And because of that, I think this is a distribution of outcomes stock. It's not a clean linear growth story. There is a wide range of possible outcomes here, and the stock could look very cheap in one future and very expensive in another. Now let's get into valuation, because this is where things become a lot more demanding. Using the current stock price of about $10 and the April 9, 2026 share count of 481.9 million, Ondas has an equity value of roughly $4.8 billion. The company also said it had cash and cash equivalents in excess of $1.4 billion as of March 31st, 2026, which implies a rough enterprise value around $3.4 billion before adjusting for debt and any post-quarter-end cash usage. Based on that, market cap to 2025 sales is about 95 times. EV to 2025 sales is about 67 times. Using the company's 2026 guide, market cap to 2026 revenue is about 12.9 times, and EV to 2026 guide is about 9.1 times. Those are not cheap numbers on current fundamentals.
For the valuation to make sense, I think investors need to believe three things.
First, that Ondas will hit or beat the $375 million plus 2026 revenue target. Second, that it can keep scaling well beyond 2026 into a much larger platform. And third, that future dilution will be manageable relative to the value being created. So my valuation judgment is this. The stock looks expensive on current fundamentals, but not necessarily expensive if Ondas successfully becomes a scaled multi-domain autonomy platform over the next 3 to 5 years. That is why the stock can still work from here, but management needs to execute unusually well.
Looking out over a 5-year horizon, I think the key question is not simply whether revenue grows. Revenue probably will grow if the company keeps expanding and winning programs. The key question is how much of that growth turns into durable per-share earnings power. That is the real issue. The positive long-term case is easy to imagine. Ondas now has a broader portfolio, more customer touchpoints, more balance sheet flexibility, and more exposure to defense and security markets that appear supportive. If it becomes a true integrated provider across air, ground, counter-UAS, and ISR, it could be a meaningfully larger and more strategically important company in 5 years.
But the limitations are also very obvious. The business may become too complex too quickly. Integration may not generate enough real synergy. Hardware-heavy defense systems may scale revenue faster than profits, and because of the share count, enterprise growth may not translate into strong per-share returns. That is why I think ONDS is really a per-share value creation story, not just a revenue growth story. The scenario analysis in the report makes that very clear. In the bear case, the idea is that Ondas continues to grow, but integration stays messy, margins remain mediocre, and the market eventually values it more like a lower-quality, acquisition-heavy defense hardware consolidator than a premium autonomy platform.
That scenario assumes 2030 revenue of $700 million, a terminal EV to sales multiple of 2.0 times, net cash of $100 million, and a share count of 650 million. That gives an implied value of about $2.31 per share, which would be a 77% downside from $10. In the base case, Ondas successfully builds a real multi-domain defense and autonomy platform, wins larger programs and improves margins, but stock-based comp, integration costs, and dilution limit the per-share upside. That scenario assumes 2030 revenue of $1.4 billion, a terminal EV to sales multiple of 3.75 times, net cash of $300 million, and a share count of 590 million. That implies a value of about $9.41 per share, or roughly 6% downside from $10. And in the bull case, Ondas turns these acquisitions into a genuinely integrated platform, wins large multi-year programs, grows recurring support and service revenue, and earns a premium valuation as a scaled autonomy and defense platform.
That scenario assumes 2030 revenue of $2.3 billion, a terminal EV to sales multiple of 5.25 times, net cash of $500 million, and a share count of 620 million. That leads to an implied value of about $20.29 per share, which would be about 103% upside. I think the most important lesson from that exercise is not the exact numbers, it is the structure of the outcomes. ONDS can become a much bigger business and still deliver mediocre stock returns if dilution remains heavy and the terminal multiple compresses. That is the key message. So, if I summarize the return drivers, the bear case is really about revenue growing but quality disappointing, with dilution and multiple compression doing most of the damage. The base case is about business growth roughly offsetting dilution and a lower valuation multiple. And the bull case is about strong growth plus a better strategic position more than overcoming dilution. Now, in terms of what could go wrong, I think the biggest risk is execution failure through complexity.
Ondas is trying to integrate a large number of acquisitions across different domains and geographies at a very fast pace. That is hard even for much larger companies.
The second major risk is dilution. The share count is already very high, the warrant and option overhang is large, and the company is explicitly seeking more authorized shares to support acquisitions, compensation, and strategic growth. The third major risk is valuation. Even after the recent pullback, the stock still reflects a meaningful amount of future success. So if growth is merely good rather than exceptional, the stock could still underperform even while the business expands. Other important risks include customer concentration in large programs, procurement timing, defense budget and geopolitical variability, margins never maturing enough to support premium multiples, and the possibility that Ondas remains more like a portfolio of separate products than a coherent integrated platform.
So, what should investors watch over the next 2 to 4 quarters? The first thing is whether Q1 2026 actually lands near the guided $38 to $40 million, and whether full year 2026 tracking still looks credible. That is probably the fastest and cleanest way to test whether management's step change narrative is real. Second, I would watch gross margin and operating expense discipline. At this point, revenue growth by itself is no longer enough. Investors need to see signs that scale is starting to improve the economics.
First, I would watch backlog and order conversion. In particular, whether recent wins, including the initial roughly $68 million order under the $140 million program, and other security and defense awards, actually convert into recognized revenue on time. And fourth, I would watch capital allocation. Are the next acquisitions clearly additive, or is the company just getting bigger without becoming better? That question will matter a lot for how the market values the stock. So my final view is pretty simple. I do not think ONDS is obviously broken. The company has real momentum, real orders, real strategic ambition, and unusually strong balance sheet for a business of this size.
But I also do not think the stock is obviously attractive at around $10 unless you have very high confidence in management's ability to integrate, scale, and create per-share value through what is clearly a very aggressive acquisition and financing strategy. For me, this is still a speculative watchlist name, not a high-conviction long-term buy. It is the kind of stock that could generate extraordinary upside in the right scenario, but it also has a very wide failure range. Personally, I would want either a meaningfully lower price or more proof that 2026 revenue growth is translating into a durable, integrated, higher quality business before getting too aggressive with position sizing. So overall, my conviction here is low to medium.
If I had to reduce the entire thesis to just a few points, I'd say this. The company has real revenue momentum, a huge amount of cash, and a much broader strategic footprint than before. But the stock also comes with very real dilution risk, integration risk, and execution risk. And because of that, this is not just a bet on business growth. It is a bet on whether that growth turns into real per-share value creation. That is what I think matters most going forward. Let me know what you think about ONDS in the comments. And if you found this helpful, feel free to like and subscribe.